Hey guys, and welcome back. Continuing with the in-class exercises. In this video, I cover 3 and 4. Okay, so 3 talks about gives us the most recent financial statements for a Saud Incorporated. Okay, they tell us that assets, costs, current liabilities are proportion to sales. Long-term debt and equity are not. The company maintains a constant 44% dividend payout ratio. As every as with every other firm in its industry, next year's sales are projected to increase by exactly 17%. What's external financing, or what is the external financing needed? So in this problem, it's pretty much identical to problem number 2. The only difference is we have dividends, okay? But it's not a problem because we know how to solve that problem. Now, bear with me here because I just want to make a few adjustments. Because here we have current liabilities and we have long-term debt. So again, to start off, I'm just going to plug in the information that they gave us, right? Originally, sales were $9,300. Costs were $6,550. So that means our net income has to be $2,750. Okay? We also have taxes we need to account for here. So bear with me here. Let me set this up a little bit better. They say the taxes, or tax, is 22%. Okay? In this case, taxes are $605. And the net income that we now have is net income minus taxes gives us $2,145. I want to change this net income to be taxable. Taxable income, and the bottom line is our net income. So very important, making sure you're recognizing what each of these line items are. Okay, costs, or revenue minus cost, gives us taxable income. We subtract out the taxes because we have it in this case. If we did not have taxes, we would just say net taxable income would be our net income. Okay. For assets, we have 4050. Those are my current assets. And my fixed assets are 9300. I apologize, my mouse is super duper fast. Okay, so then they give us our liabilities, which are 2625. Long-term debt's 4190. And equity is 6535. I'm just going to sum these up. Okay. Balance sheet balances were good. So now, what do we got going on here? Well, I'm going to try and talk while I'm switching this. So we know that, we know that sales, costs, assets, and current liabilities all are going to increase by that 17% because they're proportionate to sales. Okay, so that's the first thing we're going to do. Get rid of all this other Garbino down here. Okay, so just want to set up my balance sheet a little better here. So I want to have my current assets, my fixed assets, I want to have my current liabilities, my long-term debt, and my equity, right? Always a good idea to set up the problem, right? Because it lets us know what we have and where we need to go, okay? So we know that our sales are going to increase by 17%, okay? So make it happen. Sales times 1.17 gives me 10,881. Same thing with my costs. My costs were 65.50. Well, again, they're going to increase. I got $7,644. Okay, so we're rounding here. So if you got 7663.50 or 0.56, that's fine. I'm going to get rid of those cents because they're really immaterial to us. So we have our taxable income right here of 27 or 32.18. Now I need to figure out what are my taxes, right? What are my taxes? So very easy. I'm going to take my taxable income times 0.22. My taxes are 708. Okay. My net income is taxable income minus my taxes. 2510. Okay, again, that's rounded. You might have 2509.65. That's fine too. Usually helps if you can spell, huh? Net income. Okay, so now we have to factor in our dividends. Well, we know our dividends are 44%, right? So I'm going to take my net income and I'm going to multiply it by my 0.44. My dividends are 1104. Okay, perfect. So now I can figure out what my, I'm just going to say add or addition to retained earnings is, right? Because remember, I must repeat myself, equity is made up of a bunch of different pieces. Additional paid-in capital, common stock. We got treasury stock in there. We would even have preferred stock in there. Additional paid-in capital of preferred stock. And we would have our retained earnings, right? So there's all these pieces that we're really not seeing that are part of equity. So that's why we have to take the dividends out of our net income, okay? So how much is my long-term debt going up, or I'm sorry, how much is my equity going up by? Very easy. Net income minus my dividends, boom, okay? So now I can go ahead and calculate my balance sheet, right? Remember, assets, or the left side always has to equal the right side, always. Well, thank goodness, my assets increase in direct proportion to sales. Okay, here we go. Okay, so now I'm going to do my fixed assets. Well, 9,300 times 1.17 gives me 10,881. What is my total balance sheet or total assets worth? 15,620. Perfect. Okay, so now what I want to do over here is figure out what the right side of the balance sheet is, right? What are the amounts that I need for my liability, my debt, and my equity, okay? So right off the bat, we know that current liabilities do increase by 1.17, right? By the assets, okay? Long-term debt, they didn't say anything. They said long-term debt and equity are not proportion to sales. So I'm just going to plug in what I have, right? Gives me a nice little base to work with. I know I have to have at least 4190, right? Because that's what I had started the period off with. I have to have at least that. Now I have to calculate my equity, right? So what is my equity? Well, it was 6535, right? I add my net income, I subtract out my dividends, that's my addition to retained earnings. We already did that. We already have our addition to retained earnings right here. Oh, sorry, right here. 17,904. That is my equity. Or I'm sorry, 7940. Okay? So, does my debt and equity match? No. Or I'm sorry, does the left side match the right side? No, it does not. Well, what's the difference? Well, that's easy. I have 15,620 in assets, 12,130 in liabilities and equity. The difference is the 3489. Okay, but can I do that? Right? Can I do that? Does that work? Well, not quite, right? Not quite at all. Because, hold on a second. This is why it doesn't work. There we go. Much better. I apologize about that. I didn't add up all my numbers. That's why it looked funky. So I have to add my liabilities, my debt, and my equity. I get 15,202. So the difference between the assets and the liabilities and the equity is 418. This 418 is my extra or external financing needed. Okay. So it was good that we had that error in Excel, right? Because we looked at it and we says, or well, I looked at it and says, wait a minute, something's not right here, right? Something's not right. It didn't look like it was adding up correctly. Okay, so if you see a number that doesn't look right, it's always good to think about your numbers. What doesn't look right? Does it not look right? And then check your Excel spreadsheet to make sure that you have all the data, or you're including all the data in your answer. Okay? So let's go to number 4, right? Number 4 is pretty easy, right? Because number 4 says that we are looking for the internal growth rate. So that's super duper easy, okay? So how are we going to do this? Well, first thing we need to recognize is, how do we calculate the, I'm going to come down here. How do we calculate the internal growth rate, or the IGR? I'm going to abbreviate. IGR, internal growth rate, equals our ROA times our lowercase b, or our plowback, right, divided by 1 minus the ROA times the plowback. Okay? So that's the equation we need to use, right? So the first thing we need to do is figure out, or remember, we should say, what is our ROA calculation, right? So the ROA is calculated as net income divided by total assets, okay? So I'm going to go ahead and get rid of this. Oh, get rid of that. And to start this problem, I'm going to go ahead and I'm just going to plug in all the original information that they gave us. Okay, so what did they give us? Well, they told us that our original revenue was 19,900. Our costs were 13,600. That means our net or taxable income, was $6,300. Our taxes, in this case, were 23%. So that is 1,449. And we get net income of 4,851. Okay, cool. What are our assets? Well, assets are 11,900. Fixed assets are 30,600. We have a total of 42,500. So here we just have debt and equity, right? They kind of messed it up for us. So we just have debt. We lumped it all together. We don't know if it's long-term, short-term, whatever. It's just debt for this problem. And our equity is 26,200. Okay, so now what we're going to do is we're going to go ahead and figure out, okay, well, what exactly do we need, right? What do we need? So they tell us that assets and costs are proportion to sales. Debt and equity or not, the company maintains a 40% dividend payout, okay? So the first thing we need to do is we need to figure out what is our ROA, right? What is our ROA? What is our net income? What is our total assets? Well, the good news is we do not, because of this situation, we do not really need to apply the ROA with that increase. We can do it as is right now, okay? So what I'm going to do, I'm going to get rid of all that, okay? So bear with me for 1 second. I just want to hide this. I apologize. Well, you can fast forward. I'm trying to work efficiently here. Okay, so we need to figure out our ROA, right? We know what our net income is. We know what our fixed assets are, or our total assets. So our ROA, our return on our assets, is, let's see, we're gonna use a smaller number, is 0.1141 or 11.41%, okay? Because the sales and everything increases in proportion and the assets also increase in proportion, the ROA has to be 11.41% before the increase in sales and after the increase in sales, because we have those proportional increases, okay? So now we can go ahead and calculate before we do that, we need to talk about the plowback method, right? What exactly is the plowback method? Well, the plowback method is 1 minus the dividend payout. Okay, 1 minus the dividend payout. Well, that's easy, right? We know what that is. 1 minus, the problem tells us that the company maintains a constant 40% dividend payout ratio. Usually helps if you put an equals in there to get Excel to work. And we got 0.6, okay? So now we can go ahead and plug in all these numbers to make sure that to calculate, what our internal growth rate is. So I'm going to start here, and I'm going to break his calculation down a little bit. I'm going to take my ROA, which is 11.41 times my plowback ratio. and I need to add some decimals. So I got 0.0685, okay? Now I need to figure out the bottom half of that, 1 minus the plowback ratio. Well, that's easy. Or I'm sorry, yeah, 1 minus ROA times the plowback ratio. So I'm going to take this out 2 more spaces, just so I have 4, make them equal, okay? So I'm going to divide my 0.0685 by my 0.9315. My ROA then is, take it out two spots, 7.35%, okay? So this problem was nice. The reason why is because we need to first recognize that everything that we have in our ROA calculation increases in direct proportion. Okay, so that means that the ROA, the percentage of the ROA, is not going to change, right? If we calculate it before the increase or after the increase, because everything's changing in proportion, the return on assets has to hold that 11.41%, okay? It's the first thing we got to notice. Second thing we got to notice is, well, okay, how do I calculate the plowback method? Well, it's 1 minus the dividend payout ratio. Cool. How do I figure out what the internal growth rate is? Well, I need to remember my equation, ROA times the plowback method divided by 1 minus ROA times the plowback method. So this, my friends, is my internal growth rate. Boom. And that is number 4. Like I said, I'm only going to do 2. I'm going to try and keep these videos short. Last one was 17 minutes. I didn't time myself. I'm hoping this one's around 17 or 20 minutes. When we come back, guess what? We're going to do 5 and 6. So tune back in for that one.